What if I told you a real estate company from the Philippines just quietly slipped onto the NASDAQ? The stock exchange famously dominated by tech giants like Apple and Tesla. Could this be a bold move towards global recognition, or is it just clever financial maneuvering? Let's uncover why Hotel101's IPO has sparked so much conversation and controversy. Imagine a hotel brand from the Philippines, known locally for selling hotel rooms as individual investment units, the way developers sell pre-selling condos. Then suddenly they made headlines by listing alongside technology icons on the prestigious NASDAQ exchange. Hotel101, owned by Double Dragon Corporation and founded by Filipino entrepreneur Edgar Injap CL II, creator of Mang Inasal, a fast food chicken franchise, and Tony Tan Kak Chong, founder of the global brand Jollibee, operates under an innovative condotel model. Investors buy rooms and earn passive income from Hotel101's centralized management and booking system. So their ambitions are massive. Hotel101 plans to expand rapidly. They're aspiring to manage over 1 million standardized hotel rooms in over 100 different countries worldwide. But why is NASDAQ such a significant stage for a Philippine-based real estate business? In 1971, NASDAQ emerged quietly, changing Wall Street forever. As the world's first electronic stock exchange, NASDAQ transformed trading from chaotic paper to swift digital transaction, becoming the hub for tech-driven innovation. Today, NASDAQ symbolizes growth and innovation, hosting giants like Apple, Amazon, and Tesla, companies that shape our daily lives. NASDAQ didn't just revolutionize investing, it turned ideas into global realities. For Filipinos, and indeed global investors, NASDAQ symbolizes innovation, credibility, and access to a vast amount of capital. Hotel101's presence on NASDAQ isn't just unusual, it's unprecedented. So how did a Filipino real estate company secure a spot on the global stage? And what does it mean for the future of business in the Philippines? Stay tuned as we dive deeper into this captivating story. When Hotel101, a relatively unknown hospitality brand from the Philippines, secured its spot alongside companies like Global and Tesla, it immediately signaled serious global ambitions. But with ambition comes scrutiny. Does a real estate heavy hotel brand genuinely belong on a stage meant for tech disruptors? At face value, these innovations promise streamlined operations and better investor returns. But critics argue Hotel101's tech angle might be overstated, suggesting it's essentially traditional real estate wrapped in tech-savvy branding. The truth likely sits somewhere in between. Hotel101 certainly employs some modern technology, but calling it a true tech company comparable to NASDAQ heavyweights is a bit of a stretch. Hotel101's IPO performance wasn't stellar, but I'll get back to this later. While several ASEAN and emerging market companies have listed on NASDAQ, they're predominantly tech-oriented startups. So how did they do it? They utilize a lesser-known but increasingly controversial financial shortcut known as a SPAC merger. SPAC is short for a special purpose acquisition company. It's essentially a publicly traded shell company with no real business operations. This method enabled them to sidestep the rigorous traditional IPO vetting process, raising eyebrows about transparency and legitimacy. SPACs became Wall Street's recent favorite shortcut to the market. Born in the 1990s, SPACs emerged during an era overflowing with liquidity, when investors eagerly sought quicker ways to invest capital. These special purpose acquisition companies offered a simplified path to the public markets, allowing private firms to list rapidly without lengthy traditional IPO processes. Why the skepticism? SPAC listings historically have high failure rates, with over 90% significantly underperforming post-IPO. Imagine an empty shell company listing itself in the stock market. Sounds odd, right? That's exactly what SPACs, or special purpose acquisition companies, do. They're publicly traded companies without any actual business operation. Their sole mission is to find and merge with a private company that does have a real business, instantly making that private company publicly traded. This allows companies to skip the complicated traditional IPO process. This unusual shortcut makes going public quicker, but also carries risk and questions about transparency. This troubling track record adds fuel to investor skepticism surrounding Hotel101's NASDAQ debut. It makes people wonder, is Hotel101 genuinely poised for global success? Or are they simply riding the SPAC wave, risking future disappointment? And if that happens, how will this pave the way for future companies from the Philippines who might want to list on a US stock exchange? Will it hurt the credibility of Philippine corporations? Hotel101's much anticipated NASDAQ debut met with brutal reception from investors. The stock opened around $3.64 per share in early July, but quickly sank nearly 10% to $3.28 by the close. This was a far cry from the $10 per share deemed value that management had targeted. This weak demand meant Hotel101's market capitalization hovered near only $800 million US dollars. That's around 45 billion pesos versus the $2.3 billion or 130 billion peso valuation initially hoped for, which underscores the skepticism surrounding the offering. In short, the IPO's first day saw the share price plummet well below initial expectations. This reflected the investors' cautious outlook on the company. Why did Hotel101 skip the Philippine Stock Exchange? In fact, it made history as the first Filipino-owned company ever to trade on any US exchange. According to CEO Hannah Lucchini, the NASDAQ listing gives us the global platform and credibility to execute our long-term growth plans. Skipping the smaller PSE for a US listing provides an international stage to raise funds and boost its profile in ways a local listing could not. Over the past decade, the Philippines has boasted impressive economic growth, which averaged around 6% annually. Top companies like Ayala, SM, Jollibee saw their profits soar, but here's the twist. The Philippine Stock Exchange Index barely moved in that same period. But why? The answer is simple yet critical. Compared to global markets like NASDAQ or even regional peers, daily trading volumes in the Philippines are extremely low. Only around 1% of Filipinos invest in stocks, making it tough for companies to raise capital and for stock valuations to reflect real economic progress. Until liquidity improves, the Philippine stock market may continue to lag behind its economic success. To understand why this matters, look at how different market liquidity is different between the Philippines and the US. Daily trading volume in 2023, the PSE traded around 110 million daily, while NASDAQ traded over 200 billion. That's almost 2,000 times more. And comparing IPO sizes, in 2023, the average IPO in the Philippines raised about 26 million. On NASDAQ, the average IPO raised over 100 million, nearly 4 times larger. For perspective, consider how small even the Philippines' largest IPOs are compared to Hotel101's NASDAQ bid. The largest IPO in PS history was Monday Nissan, and in 2021, they raised 48.6 billion pesos, approximately 1 billion US dollar. That's not much more than Hotel101's $800 million raise. Ayala Land's landmark 1991 IPO raised 2.5 billion pesos or 44 million US dollar. Even Hotel101's parent company Double Dragon's own 2014 IPO was approximately 1.16 billion pesos or 28 million US dollar, which is tiny in comparison. That's almost 35 times smaller than their subsidiary. This huge difference shows why listing on NASDAQ can be so attractive for ambitious companies. In light of these figures, Hotel101's NASDAQ listing, despite its initial disappointing price drop, stands out as a major strategic win. By tapping into NASDAQ's vast liquidity and global investor base, Hotel101 achieved a scale and exposure that no PSE offering could match. In essence, a short-term setback of a weak debut may be worthwhile trade-off for the long-term benefits of a US listing. This positions Hotel101 on a far bigger stage than what the local market could ever provide. So this path, though unconventional for a real estate hospitality hybrid, could serve as a blueprint for Philippines corporations who are seeking growth beyond this local confine. However, this strategy isn't without risk. The high failure rate of SPACs and the scrutiny of international investors mean that success requires more than ambition. It demands robust business models and transparent governance. But if Hotel 101 can navigate these challenges and prove its merit on the global stage, it may pave the way for other Filipino enterprises to follow suit, potentially transforming the landscape of Philippine business. This isn't just a business story. It's a bold new chapter for Philippine companies dreaming big. If you believe Filipino businesses deserve a bigger stage and a brighter spotlight, share this video. Let's inspire more conversations about taking local brands global. Make sure you subscribe to get more in-depth videos like this about the growth in the Philippines. And I'll see you in the next video.